Hi, folks. This is Mike Zlotnik, and today's discussion is going to be why real estate funds have lower risk, lower volatility, and higher predictability than single asset syndications. And again, we're going to talk about this in general terms with some examples. But before we do that, this presentation is for informational educational purposes, no solicitation of any kind, no advice of any kind. Consult with your attorney and CPA professional before making any investment decisions. And if you're interested in any of our funds or syndications, request PPM, private placement around to accredited investors only. Well, after this wonderful disclaimer, let's jump into the crux of the presentation. So, real estate funds, and by the way, the concept applies to other non-real estate funds too, stock market funds and so on. But I will focus on primarily real estate funds. Let's first of all talk about a few different types of funds and then quickly jump into how funds mitigate risk, reduce volatility, and increase predictability. So real estate funds could be broadly diversified or could be single strategy funds or single location funds or single area funds. So for comparison's sake, broadly diversified funds typically raise capital from investors and spread that capital among many strategies, multifamily, storage, industrial, retail, so on and so forth, and in different regions of the country and with different operators. That strategy effectively creates broad diversification, many dimensions of diversification. Now let's look at the single strategy funds. Single strategy funds such as self-storage funds, multifamily funds, industrial funds, or they could be concentrated in a given area funds, like New York City fund, or New Jersey fund, or Midwest fund, or Pacific North, or Rockies, mountains. There's different type of areas. These funds have certain concentration. Nonetheless, they still diversify among many investments. So let's just kind of go into the mechanics, compare and contrast. So single asset syndication, maybe multifamily, storage, or so on, or another one, is concentrated in that one transaction. And if that transaction does well, it can produce great results. And if it doesn't do well, you could lose all the capital. So I'll give you an example. Volatility on a single asset syndication could be tremendous. From a worst case scenario where you lose 100% of your capital, which is a negative 100%, to an example of a pretty good return, you triple your money. So you get 200% return upside. So volatility between positive 200% and a negative 100% is pretty massive volatility. Now, that's not a normal outcome. The deal may have pro forma projected target return of, let's just say, 17% IRR. So that's what it's expected. But a volatility, which means range of potential outcomes, is very high on a single asset syndication. It's always the case, and so is the risk. And volatility is also a function of a few things. Obviously, really a function of a strategy. So depending on what the fund invests in, volatility could be high or low based on that strategy. So let me give you some examples. Let's just say you take a strategy where it's ground up construction or whatever it is, storage, multifamily, industrial. Ground up by itself is a higher risk strategy because there could be delays with construction, stoppage of work, cost overruns, time extension, a number of other variable factors that increase risk on the project. And so it increases the volatility. So more projects also the success of projects really depend on market conditions. So ground up is just volatile by itself. Then you go into a recessionary environment, or you go into the expansionary environment. During the good times, these projects look a lot more attractive. And during the bad times, during a recession, they look a lot more speculative because the risks are way higher during a recessionary environment. So the strategy actually impacts quite a bit of what a volatility of certain strategy, the strategy impacts the volatility. So a given syndication with a certain strategy has certain level of average volatility. Now, if you go into funds, the funds smoothen the journey quite a bit because a fund spreads the money among many investments. And let's just say we'll use a fund that spreads the money between 20 to 30 investments. Of course, funds vary. Some funds just do 10 investments. Some even do less. Some do more than 30. But in concept, when you break the money into 20 to 30 deals, some deals will fail, some deals will succeed tremendously, but on average, the volatility drops massively versus single asset syndication. So predictability is, by the way, kind of the opposite of volatility. As volatility drops, predictability increases. So what does it mean? So as I gave example of a single asset syndication, your volatility range of the outcome between is a negative 100% all the way to positive 200%. On a fund, you may have a target return of, say, sake of simplicity, 15%. But the volatility range is way lower, is way tighter than the syndication. So volatility range may be in a not a great outcome would be 10%, and in a great outcome would be 20%, plus minus 5% per year on average volatility target. So volatility of a fund is way closer to its projected target return than on a single asset syndication. So again, funds effectively spread the risk among many investments. So the risk mitigation is way stronger on a fund than on single asset syndication. On top of that, the same methodology, the same approach to spreading the risk reduces volatility. That investments on average will actually create total fund returns, kind of risk-adjusted average target return to a way tighter range than single asset syndication. That's why on funds, when you hear projected target return, you hear a range. For example, you could have 10 to 15% range, or 12 to 18% range, or could be a tight range, 14 to 16%. It really depends on the projected numbers, pro formas of the fund, its strategy, what it invests in. Some strategies, as I mentioned, have greater volatility, some have lower volatility. For example, first lien mortgages have way lower volatility. So conservative fund that loans first lien paper, first lien debt, it might have a target return of 9 to 10%, with volatility probably really only 1 or 2% up or down. It's really not going to greatly outperform, nor is it going to massively underperform. So it's 9 to 10% target with volatility probably, let's just say 8 to 11, right? That's a tight range. It's a lot more predictable. Now, if you make one hard money loan, single asset deal, you will still have a higher volatility, even though it's a conservative strategy. So depending on the outcome of the deal, you're probably not going to lose your principal. It's unlikely on a first lien conservative lender written paper, but you'll never make a home run either. So I would say that depending on the circumstances, in a deal like this, if the market softens, foreclosure takes longer, there are other challenges, maybe you just recover your principal. So in a bad case scenario, you get your money back. In a good case scenario, you may get some default interest charges, some late fees, so on and so forth. So you might wind up making 16, 18%. So you have target range of 9 to 11 and volatility ranging from 0% return to positive 18%. So fund smoothens the journey tremendously by tightening that range. Then on average, you only have 8 to 11% projected volatility. So this concept is something that folks need to keep in mind. Now, depending on individual circumstances and depending on your own financial situation, you may be totally comfortable with a bunch of syndications and the connected volatility, risk, and lower predictability. Totally up to you. Different strokes for different folks. For some folks, predictability, lower volatility, lower risk is a lot more attractive. It's kind of a boring, that's what they say, the diversification is boring. Some reason the term diversification always is associated with the term boring. Is boring good or bad, right? In my view, it's actually good because you have more predictable, less volatile results. You know more or less what you're going to get. Of course, there's going to be some uncertainty and some volatility in any strategy, even the funds, but it's a lot tighter volatility and a lot more predictability and lower risk. That's the story with real estate funds or funds in general. And I hope this was helpful. Appreciate your time and attention. Until the next time.